Hey, what's going on, guys? Leo. So we got some interesting news. Looks like the government has started to publish macroeconomic data on chain. So, article from Crypto Briefing says the U.S. government has tapped Chainlink and Pyth network to deliver official economic and financial data on chain, according to two separate announcements from the project. The integration initially targets 10 blockchain networks, including Arbitrum, Avalanche, Base, Botanix, Ethereum, Linea, Mantle, Optimism, Sonic, and ZK Sync. Now, what's interesting is that most of those are Ethereum. Base is Ethereum, Arbitrum's Ethereum, Mantle, Optimism, I believe Linea as well, ZK Sync, of course. So it's really interesting that we're seeing them move onto the Ethereum network, the Ethereum ecosystem. And this is a really big deal because financial transparency will prevent massive financial collapses like we've seen in the past. For example, FTX, if those deposits were stablecoins and you could track the stablecoin wallets and you would see that, wait, all my money's gone, immediately people would have stopped funding the Alameda FTX crisis. And I believe that is where we're headed. We're headed to a financial system where financial contracts, trading platforms, everything, they're going to essentially be decentralized exchanges, decentralized applications. And I believe that because it eliminates a lot of counterparty risk, it eliminates a lot of the hazards and opaque financial markets that we have today. Now, whenever I say decentralized, I don't necessarily mean that you won't have a centralized company behind it that built it, but it's going to be similar in that everything is going to be on chain. It's going to be built out with smart contracts and whatnot. And that is going to allow for radical transparency within the financial markets. Now, I want to move on to something interesting here. So apparently Solana is really struggling to gain any stablecoin traction whatsoever. They've been sitting around 11 billion in stablecoin market cap, going all the way back to the beginning of the year. So it jumped up. They were all, hooray, we're gaining stablecoins, and they've basically actually lost stablecoin market share. Meanwhile, if we look at the Ethereum ecosystem, it's going absolutely vertical. And this is what I'm talking about. This is what Ethereum network effects do. So if you're a layer one chain trying to build outside of the Ethereum network, you are not building a blockchain. You're not building a decentralized blockchain that can take advantage of these network effects. You are building a centralized walled garden that makes it very difficult for anyone outside to come and start to participate inside of this centralized layer one, because you're starting to introduce counterparty risks. And that's one of the big advantages to financial markets, is to not have a counterparty risk. So what we're going to see, and Google, they just recently launched their own layer one chain. And I'm going to make a prediction. All of these are going to pivot, and they're going to pivot to being Ethereum Layer 2s. The reason being is that even Google will not be able to compete with Ethereum's network effects. That is how big of an advantage Ethereum has over all these other Layer 1 chains, because it's effectively like all these companies are trying to, instead of building applications that can function on Windows or Mac, they're wanting to build their entire new operating system. And you end up with this fragmented system that just becomes very difficult. I remember back in the day where you would have a ton of trouble going from a document, like a Word document that was done on a Mac, and sending it over to a PC. They were practically incompatible. And so imagine that same dynamic playing out when you're trying to build this massive new global financial infrastructure, and nothing is compatible. It's slow. There's frictions. The point of Ethereum is to provide a decentralized base layer operating system, ledger for the world that everybody can build on, not to build a bunch of layer one chains that are fragmented and slowed down. It's not going to be very easy for someone to go from, say, Ethereum to a Google L1 and then do business with another L1. It's just going to cause more fragmentation and more headaches. And so I believe they are all going to realize that very quickly, and they're going to pivot to Ethereum Layer 2s. Now let's let's listen to Tom Lee, see what he has to say here.
I've seen those charts with global central bank liquidity and Bitcoin, and Raoul Pal, I think advances at 16 months, and it's been pretty dead on in explaining crypto. And so I would say that in my mind, it's intuitively logical that global liquidity is a reason why crypto prices do well. Okay. But I think there's a second story arc developing in crypto, which is that was also true when the singular narrative for crypto was, well, it's digital gold, or it represents a vector of trust or of risk appetite, plus it trades 24/7. And so that's why we want to look at it. And maybe that's why people look at it and describe Bitcoin. But now I think that the narrative is changing for a couple reasons. One would be the institutional sponsorship of Bitcoin plus government sponsorship. To get you a template on that, look what happened to venture capital and private equity. Venture capital used to be very predictable cycles, and private equity too, because it was primarily family offices buying it and selling it, and it was very short cycle, and they couldn't, they never really raised a lot of money. The minute it became an institutional sector, it has completely transformed the cycle in venture capital and in private equity. There hasn't really been a private equity cycle since you've had institutional flows into the private equity sector, and now private equity is larger than cash equities. But I think the second story arc is that AI and adjacent to it is financial innovation. Like, these two really huge story arcs are starting to take place.
So a couple of things there to break down. First is going to be the global liquidity that he's talking about, and what I've talked about quite a bit on this channel. And you essentially have two components. You have central bank policy, which is going to be whether they're pumping money into the system, buying financial assets like mortgage-backed securities, or whether they're influencing interest rate policy by lowering interest rates or raising interest rates like they have done to fight inflation. Basically, that is how they are going to be pulling money out of the system or injecting money into the system is interest rates and the purchasing of assets. So what's interesting is that the Fed is just starting to pivot. They're just starting to cut interest rates, and we're seeing that in the chart here, dictated by the red line. This is global liquidity. Now, every single crypto cycle has always been dictated by global liquidity, because the more liquidity going into the system, the easier it is for business to take place. So we have that going for us, right? So this is basically the beginning of this new liquidity cycle where crypto is going to start going to new all-time highs. The other part of what he's talking about is you essentially have a different flow structure, where prior to previous bull runs with crypto, you would have essentially retail buyers. You would have some institutions being a little bit more risky and buying in, but now that you have this regulatory clarity and whatnot, and you have institutional adoption, these institutional treasuries being interested, and talks of trillions of stablecoins, trillions of RWA tokenization, so bonds, stocks, and whatnot, we're seeing a complete paradigm shift in the flows. We've never seen this amount of capital just flowing into Ethereum before, or crypto in general. So essentially, the traditional cycle is very likely breaking as we are moving into a sort of super cycle mass adoption event within this space. And so what does that look like? Well, we can take a look at Apple, get kind of an idea of what we could start to see. You'll notice back in the 80s, 90s, Apple kind of just traded sideways, for a long time. And then we hit the iPhone moment. We hit the adoption curve where everybody, Apple became a very, very well-known household name. Everybody that I know practically has an iPhone nowadays, and Macs are, of course, extremely popular computers. And so you see this massive adoption where price just, it has pullbacks. I believe this was a 60% pullback, but you don't get these prolonged bear market cycles like we've seen in crypto. So it's very possible that we just see something similar where we just begin to grind higher as more and more mass adoption happens. It's very possible we don't see the traditional bear markets that we are used to within crypto. And that's just something in general with markets. Whenever a pattern continues to repeat like clockwork, everybody catches on and then the pattern breaks. So I think that pretty much wraps up today's episode. If y'all have any questions, leave them in the comment section down below, and I'll see y'all next time.